Okay, welcome back and good afternoon, everyone. Welcome back to our options education webinar series. Today, we're going to be talking about discounted stock purchase with a cash secured put. This is a strategy that is, in my opinion, quite underutilized by most options traders, even though it's really a strategy that's geared more for those of you that are equity investors. So anyone that's ever purchased a stock or is looking to purchase a stock in the future, this is a strategy you should be really considering as a strategy for your toolbox whenever you're thinking about buying a stock. And the goal here is to really help you dollar cost average and acquire stock that you want to own in your portfolio at a discounted price by selling cash secured puts. So that's what we're going to go over here today. This webinar is recorded, so I will send out the recording about 30 minutes after we finish here, and I will include the slides for everyone. So for those of you that are brand new to options play or just first time learning about these strategies, you'll have the slides to be able to follow along afterwards. Before we get started, just a little bit of housekeeping. So for those of you that are brand new to Options Play, welcome. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. We do weekly webinars to help you guys learn about option trading strategies and topics. So today we're going to go over how to sell cash secured puts to purchase stocks at a discounted price. But for those of you that are brand new, if you haven't used Options Play, you can sign up for a free 30-day trial at optionsplay.com. Membership runs $50 a month or $500 a year to have access to this platform, the weekly educational webinars, including daily trade ideas that we send out. So some of you that have signed up for a free trial or a current subscriber, you're probably receiving our daily trade idea recommendations. These are things that you have access to. But during the webinar today, I will reference perhaps some of the previously recorded webinars, or I may come across a topic where I'm referencing a previously recorded webinar. For those of you that want to access that, when I send you the slides this afternoon after we finish, there is a link in the slides to take you to the previously recorded educational webinars. Please take a look at those, especially for those of you that are learning about options. Take this time to take these resources to help you learn about other strategies and other techniques such as money management that are very important for getting started with options trading. And for those of you that are brand new to options, I highly recommend you to take a look at the Options Industry Council. It is a great resource. It's a free resource that's available for everyone to learn more about option strategies as well as option terminology. So if any terms in here today that you don't understand, I highly recommend you to take a look at the Options Industry Council in order to learn more about that. So with that, let's go ahead and get started here. Today, we're here to talk about selling cash secured puts as an alternative to outright purchasing your stock. And the reason that I think this strategy is a fairly underutilized strategy is because I think there's the perception that this strategy has a lot of risk. And it's true, selling a put compared to some strategies like buying a call or a put certainly has a lot more risk, but that's not a fair comparison because it's not the right comparison to make of selling a put versus buying a call. I think the right comparison to make here is selling a put compared to outright buying the stock with a limit order. And if you put those two side by side, I think once we do that, it'll become clear as to why the cash secured put sometimes may be a slightly better strategy than outright buying your stock, and why you can pick up some stocks at some discounts by selling a cash secured puts. So we're going to go through a couple of examples. So I want to talk about the trading strategy itself, and I'm going to talk about the different outcomes that you'll have, both for a stock purchase versus a cash secured put, so that you can see the two side by side, and it'll help illustrate as to the difference between the two and what are the benefits and limitations of each one. Then we'll talk a little bit about best practices and tips in terms of selecting a cash secured put. There's a few different things that you have to account for, such as time frame and your risk tolerance to determine what expiration and strike price. So we'll talk a little bit about that to optimize for where you will find the best yield to help you really provide the most discount on the price purchases or the stock purchases that you'll make. And then what we'll do is we'll wrap up with showing you the weekly short put report that we put out every single week. This is really helpful for those of you that are short on time and you want to be able to scan a report very quickly to see what opportunities are there to sell some cash secured puts on the stocks that you want to own. And lastly, what we'll do is we'll spend a bit of time using Options Play to show you how you can take the methodical approach that we're teaching you on this webinar and how to apply it instantly to your portfolio using Options Play in as little as a few seconds. So that's the goal that we're gonna try to cover here today. I'm gonna keep this webinar fairly short because this is just a single strategy. We're not covering a lot today, but it is very important just to understand the difference between buying a stock and selling a cash secured put. So let's go ahead and get started here. So I have an example here of Apple stock. This is a stock that has really taken a huge hit over the last 6 months or so. The stock peaked around 230, 240, and went all the way down to in the low 140s and just started to recover. And I think this is an opportunity for a lot of users to think about going long the stock. We went long the stock on a tactical options trade about a week and a half ago. We actually just got out of that trade earlier this week. But for those of you that are long-term stock investors, this type of correction off the 148 low is the type of opportunities you're looking for if you're a long-term investor and you want to buy into a stock at a lower price. So Apple stock, however, it did rally quite a bit over the last few weeks. On the short term, it's a little bit overbought, so you may be a little gun shy about pulling the trigger on buying the stock at the current levels. And this is a stock that I personally like, but I certainly think that 170 may be a little rich to pay in the short term. So I think many of you may have the same views on perhaps this stock or other stocks similar to this, where you think that at the current price, it's a bit too expensive and you wish to purchase this stock at a lower price. So the goal here is that you want to buy the stock on a pullback, and perhaps you might find yourself in the scenario where you want a dollar cost average. Maybe you already own some of this stock, but you want to buy some more and you want to dollar cost average your position. So this is the scenario that that I currently find myself in a stock like this, and many of you may find yourself to feel in a similar way. So before I move on, I just want to launch a quick poll here. I want to gather what type of order types do you typically use for your stock purchases? Do you use a limit order to buy your stock? Do you use a market order, or perhaps other orders like stop orders or marketable orders that you might use? I just want to get a sense for what type of orders people use to purchase their stock. So it looks like about 2/3 of you have voted already. 80% of you say you use limit orders to purchase your stock. 15% of you say you use market orders. And let's see, about 10% of you use other types of orders. Okay, great. So the vast majority of you like to use limit orders to buy your stock. This is exactly what we were expecting. And this is certainly what the majority of users that want to purchase a stock would use to purchase their stock. Market orders are really for those of you that need to get into the market or out of the market at the very current price, or rather need to get in and out very quickly. Then you use a market order. But for most of you, like the polls show, you use a limit order to buy your stock. And that is pretty much in line with what we would expect, because most of you will want to buy stock at a lower price. And that's the goal here. That's the whole point of why we're here on this webinar, is how do we acquire our stock at a discounted price, which is what you're typically looking for when you put in a limit order. So in the example here where the Apple stock's at 170, I have a chart here. The Apple stock's trading just around 170. As you can see, I have this red line here around the 160 level. That's a level that I would feel a little bit more comfortable owning the stock at. That's where I would typically think about putting in a limit order, because the short-term momentum is quite overbought. I think that there's a possibility of a short pullback, and I want to be able to take advantage of that and place a limit order to buy that stock. So what I want to show you now is the comparison between putting a limit order versus shorting a put and seeing what the different outcomes can be. This will help alleviate some concerns that people may have regarding short puts. Now, before I actually launch this poll, I want to ask a quick question. What are your thoughts on a short put strategy? For those of you that are familiar with it, I want to get a sense for how many of you currently use it, how many of you understand it but have not used it before, and how many of you feel that this strategy is too risky. Okay, so it sounds like many of you have actually used this strategy. So this was actually a little higher than I was expecting. So more than half of you say that you've used a short put. So it sounds like many of you are familiar with the benefits of a short put. 30% of you say you understand it, but you haven't used it. So hopefully this will help educate you a little bit about the strategy and why you should consider utilizing the strategy. And for the 10% of you that say this strategy is too risky, I hope that I can dispel some of those myths about this strategy being too risky, because once you compare it to outright buying the stock with a limit order, I think you'll see that this is not necessarily a riskier strategy. If anything, it's actually less risk. And that's really what we're hoping to illustrate here today. So again, 55% of you say you use this strategy, 30% of you have not used it, but you've seen the strategy, and 10% of you say it's too risky. So let's go ahead and take a look at this strategy. Let's take a look at the comparison between in this Apple example, when the stock's trading at 170 and you want to buy at a lower price, what are the differences? So here, on one side of the equation, if you are a stock purchaser and if you never traded an option before, you would place a limit order. It's a simple trade. You place a limit order that allows you to buy the stock at 160. On the other side, for a short put seller, what you can do is you can sell a 1 month put, same thing at the same price that you would place your limit order at. So let's say you sell a 1 month 160 put, and for that what you do is you collect $2 by selling that put. And this is really where a lot of users have this misconception of a lot of risk, because you're collecting $2, but you're risking $158 to place that trade. And that doesn't sound like a very strong risk reward ratio. However, let's take a look at the outcomes and see the difference between the two. So in the first outcome, where the stock simply moves higher. So the stock's at 170 right now. There's always a possibility the stock simply just continues to move higher. We've seen it before, especially in a stock like Apple. Not crazy outcome where the stock moves higher. If you placed a limit order, this order would simply go unfilled. There's nothing to do. The order will just sit there and will go unfilled. And you don't make any money, you don't lose any money. In the case of the short put, if the stock moves higher, you just keep the $2, the premium that you've kept, and you can actually sell another put again. You can sell a higher put, you can sell the same put again. Whatever it is, you can actually continuously repeat the short put opportunity and continue to collect income. This is the income stream that you're able to generate that you wouldn't be able to do if you simply placed a limit order. If the stock goes below 160 between now and expiration, on the limit price, you own the stock at the limit price. Perhaps you get a few cents of price improvement from your market maker or your brokerage firm, but for the most part, you own the stock at the limit price that you asked for. Conversely, if you sold the cash secured put and the stock goes below 160 at expiration, you actually own the stock now at $158 because you've collected that $2 premium. You get effectively a $2 discount from owning the stock at 160. You technically own the stock at 160, but because you've received $2 to place that short put, your net effect on that trade would be you would own that stock at 158. So if the stock goes below your limit order price, you now own the stock at a slight discount. Conversely, if the stock, and in this particular case, if Apple goes all the way down to zero, which is always a possibility after you own the stock, that the stock goes bankrupt, whatever that is. In the case of Apple, very unlikely, but let's just say that happens. If the stock goes to zero, your loss here is $160 per share. Now that's quite a bit of money to lose. However, if you had shorted the put, you actually only lose $158. Not much better, but you do actually risk less than if you outright bought the stock at 160. So this is really where, when you make the comparison between buying the stock with a limit order versus buying the stock with a short put, you actually have less risk than if you outright bought the stock. And that's really the correct comparison to make when you're talking about risk. The short put is not something you should compare to outright buying a call or a put, because it's just simply not the right comparison to make. So moving on. So now that we talked about the short put strategy, what are the obligations and what are the outcomes? Because so far what I've painted is a fairly favorable picture for shorting puts. So I want to make sure we all understand what is your obligation when you short a put. So number one, when you short a put, you have an obligation to buy the stock at the strike price, which means that if you don't want to own that stock, if this is not a stock that you want to own, if Apple stock is not a stock that you want to purchase at 160, you probably should not be selling that put. Meaning if you are selling a put, it means that you have the obligation to buy it. This better be a stock that you want to own. So think to yourself, is this a stock that I want to own in the long run? If that's the case, short put is a possible opportunity for you to purchase the stock at a discounted price. Second of all, when you short that stock, it does require cash or a margin in order to buy the stock. So when you sell that cash secured put and you collect the $2, you're not just collecting $2. You have to reserve a piece of your account to purchase that stock in the case that the person who bought the put from you exercises that put. So you do have to set aside cash in order to sell that put. It's not just you collect $2 magically and you're able to sit on it. Which is similar to placing a limit order. When you place a limit order, your broker needs to first reassure or check that you have enough capital to purchase the stock. If the limit order does gets triggered, similar type effect. When you sell a cash secured put, your buying power is reduced by a certain amount, either the full dollar amount or a portion of it, depending on if you're trading on margin. Each contract that you sell does require you to purchase at least 100 shares. So the one benefit to buying a stock on a limit order is that you don't necessarily have to buy in 100 share increments. When you sell a cash secured put, you must sell them in 100 share increments. So perhaps on a stock like Amazon, you may not be able to do this because perhaps you just simply don't have enough cash to buy 100 shares of Amazon. So this may limit you in terms of your account size as to which stocks you may be able to sell a cash secured put on. So if you don't have enough capital to buy 100 shares, this is not a strategy that you can implement. So for those stocks, the only thing you can do is simply place a limit order for 20 shares or 30 shares or however number of shares you can afford to purchase. And lastly, this is actually one of the few examples where early assignment is actually favorable. When you have an early assignment on a cash secured put, that means you've effectively gotten the cash discount on the order to buy the stock instantly. You didn't have to wait for the stock you didn't have to wait for the put to expire. You're able to instantly capture the $2 or $3 income that you receive and apply it to the discount of purchasing that stock, perhaps even before the stock is trading below the limit price. So it really allows you to purchase the stock at a discount early than having to wait all the way till expiration. So this is one of the few cases where early assignment is favorable. So what are the outcomes when you sell a cash secured put? Number one, if the stock goes higher, you keep the premium at expiration. This is, I wouldn't say a best case scenario, but it really allows you to continue to sell another put and get even further discounts on your stock. So if you sell a put 1 month for $2 and expires worthless, you can sell another put for another $2, and maybe next month you now get a $4 discount on the stock. And you can continuously do this until your stock gets assigned, and you can compound the premium that you received into a discount for the stock that you want to own. In the case where the stock goes below your strike price, you own the stock at the strike price minus the premium that you received. And keep in mind, it's not just the premium you received that round. If you've sold multiple puts on that stock, you can collect all of that premium together and get a nice discount on the stock purchase price. And last but not least, your max risk on this strategy is always the strike price minus the net premium you've collected of all the puts that you've sold on that stock. So it really reduces your net risk. So in the unlikely event that the stock goes to zero, you are actually risking less money than if you simply outright purchased a limit order. So those are some of the benefits, in my opinion, of selling a cash secured put. I will say I would say perhaps downside to selling a cash secured put is if you get a very quick dip below your limit order price and the stock jumps right back up above it, that is where a limit order would be able to capture that, where a short put may have missed out on that, because if the stock dips below your strike price and then dips back above the strike price before expiration, it's possible that the long put holder did not exercise that early. And what you do is you actually miss out on a rally that you would have participated on if you simply place the limit order. So that's the one downside, in my opinion, to shorting a stock. But if your goal is to dollar cost average in the long run and you're not trying to be tactical in the short term, this is a strategy that really allows you to purchase stocks that you want to own at a significant discount, as I'll show you with some stocks that we'll be looking at. So as far as a trading strategy goes, this is really something that you want to deploy for your portfolio when you have a neutral or bearish short-term view on an underlying stock, but you have a long-term bullish view on that stock. So like I said, in Apple, I have a long-term bullish view in Apple. I feel that the correction that we've had over the last 6 months in Apple is a bit overdone. It's starting to turn around, so I have a long-term bullish view. But over the next couple of weeks, I have a fairly neutral, perhaps even slightly bearish view in the short term. That's why I would want to consider selling a cash secured put. And for those of you that may already own a stock and you want to purchase some more, this is a great way to dollar cost average into a stock without constantly trying to chase this stock at a specific price. Simply selling puts methodically, month after month, allows you to simply slowly acquire more stock at a more discounted price. And this is an ideal way to continuously build a portfolio for those of you that have a long-term buy and hold portfolio. And lastly, this is the only situation where this is not ideal is if you have a short-term bullish view. So if you feel that Apple is going to continue moving higher in the short term and you want to capture that, this is not a strategy that you want to deploy. You may want to better off just simply place a market order and buy the stock at the current price if you have that short-term bullish view. So with that, just to compare that to the stock alternative, again, you want to compare it to buying the stock at the current price or at a limit price rather. It is less risk than outright buying the stock with a limit order or a market order, and this will generate income if the stock simply moves higher. If you place a limit order, you really have nothing to show if the order goes unfilled. When you short a stock, you actually get some income. So worst case, if the stock just takes off and you don't participate in that, you at least have a few dollars that you've collected for income, which usually ends up being quite a bit of yield if you look at a portfolio. So those are some of the things I want to analyze with some real examples of some stocks that I want to take a look at. So now that we have a pretty good understanding of the strategy itself, when you should utilize it, why you should utilize it, I want to explore two things. Number one, when you're picking a short put to trade, what expiration and what strike prices should you be looking at? So this is a time value curve. This represents the time decay of an option, and decay is something that works in your favor when you sell an option. So one of the things that you want to look at is that, as you can see, the decay of an option accelerates as you get closer and closer to expiration, where we actually see approximately the same amount of decay in the last month before expiration as you do in the previous 1 to 2 months prior to that. So you can actually collect roughly the same amount of decay in 1 month as you do in a 2 to 3 month period if you sold a longer dated option. And that's why for most cases when you're selling cash secured puts, you want to be focused more so on weekly options. So to the shorter end of the curve when it comes to expiration dates, because it's really going to allow you to accelerate the decay and accelerate the premium that you receive in a fairly short amount of time. And it also at the same time provides you with a shorter term view into where that option will likely be exercised. So this is the reason why when you're selling cash secured puts, you want to focus your attention on more shorter dated options. And we'll show you how you can input these settings into options play so that you are only looking at short dated options when you're selling cash secured puts. When it comes to strike selection, this really depends on how conservative or aggressive you are with respect to chasing the order. So for example, if you typically place a limit order very close to the current price, you would fall under the aggressive end of the spectrum, meaning your priority is to get executed and to own that stock, even if you're not getting as big of a discount. On the conservative end of the spectrum, this is for those of you that are really being patient about buying that stock. You really want to make sure you buy the stock at a very low price and you're okay by not chasing the market, and you're okay in being patient and waiting. So, and then most of you will probably be somewhere in between what I consider optimal. This is really where, based on these three categories, that will help you determine which strike puts you should sell. We always use delta to give us an idea as far as how to go about selecting strike prices for selling cash secured puts. We also do the same thing for cover calls. So many of you may have watched some of our cover call webinars. We do similar type methodology when it comes to selling cover calls. But for cash secured puts, we usually like to use, for myself, a little bit more aggressive, because when you're selling a cash secured put, just like when you're trying to put in a limit order, you want to get filled. You want to own that stock. So I tend to be a bit more aggressive, and this gives me, I usually chase about 30 to 40 delta puts, which gives me about a 60% chance of that put expiring worthless, about a 40% chance of that call or that put being exercised. For those of you that are looking for optimal puts, this gives you a 30 delta put, which has about a 70% chance of that put will expire worthless. And for those of you chasing conservative puts, we usually want to target roughly about a 20 delta put, or about an 80% chance that those puts will expire worthless. So those are the targets that you typically want to be looking for if you're selling cash secured puts when you're selecting your strike prices. So just a summary in terms of optimal expiration and strike prices for selling cash secured puts, we usually want to start with short dated expirations, because again, that maximizes theta, which maximizes your yield. This typically tends to be in that 4 to 7 week range that you'll typically find these optimal expirations. As far as strike prices go, we usually want to select strike prices near the current price, because again, when you're selling a cash secured put, unlike a cover call, when you're selling a cover call, you don't want that call to be exercised. When you sell a put, you generally want that put to be exercised, because the goal of selling a put is to own that stock. So as long as your goal is to own that stock, you want to sell a strike price near the current price. So about a 30 to 40 delta is a good range to target. And this really increases your probability of owning that stock. And that's the reason why we tend to chase these fairly aggressive strikes when it comes to selling cash secured puts, which is the opposite that we typically do when we're selling cover calls. So with that, what I want to do is I want to show you two things. I want to show you options play, but I also want to make sure that you guys understand that we have a weekly income report. So this is something that we mail out every single Monday around right around the open. So for those of you that are subscribers to Options Play, you've probably have been receiving these emails every single week. We send both a cover call and a cash secured put report every single week. The cash secured put targets a 45 days to expiration. It targets the 30 to 40 delta puts, and it sorts it by the highest annualized yield. And we take the top 100 stocks by market cap. We take the S&P 100 and we sort it for you so that you don't have to search for it yourself. You just simply get a report every single Monday morning, and you get to see what stocks have the highest yields for selling cash secured puts. And you can look through that list to see if any stocks are stocks that you want to own. And if they are, it really it tells you exactly what the bid ask, the strike price, the number of days to expiration, as well as both the raw return and the annualized return of that short put, to give you an idea as far as how much discount you're actually receiving. And you'll see that most of them will actually give you many times anywhere from 1 to 2% discount off of the outright stock price. So 1 to 2% discount off of the limit price if you were to place a limit order to buy that stock. And for those of you that maybe you can bookmark these links too, you can actually just access these reports at any time. You don't have to wait for our emails. We have these links that are static. They're the same every single week. We simply just update the report when we have the data ready. So you can also bookmark these links if you don't want to have to look for the email every single Wednesday. So again, these links will be included for you in the slides that we send after the recording this afternoon. So today we're going to be talking about income strategies with Options Play. So I want to show you, number one, how to set up what we're talking about here in Options Play, so that how you can quickly go through a list of stocks that you want to own, and within a few seconds know exactly which cash secured put to sell on each one of those individual names. So here's Options Play. For those of you that are brand new, welcome. The platform itself is divided into 3 sections. We have trade ideas and watch list here on the left-hand side. We have our security analysis panel here in the middle, and we have trading and income here on the right-hand side. So today what we're going to do is we're going to look at a watch list, and I have an income watch list set up. You can set up your own watch list with the stocks that you want to own or stocks that you are looking at or potentially want to own. And what we're going to look at is the income tab. The trading tab is designed for those of you that want to speculate. You know, if you have a short-term bullish, bearish view on a particular stock and you want to speculate, we have a whole set of webinars designed to help you navigate those scenarios. But today we're going to be focusing our time on income. How do we capture income? And more specifically, how do we capture income while purchasing a stock at a discounted price? So when you utilize Options Play for selling cash secured puts, you want to click on the income tab. But before you actually do anything, you want to click on the button here at the bottom that says income settings. This is really where we talk about the settings that we discussed in terms of selecting an expiration date and strike price. When it comes to selecting an expiration date and strike price, we, number one, allow you to do it separately for covered calls and cash secured puts. So usually when we talk about covered calls, again, we always tend to prefer a shorter dated option for covered calls as well because of that maximizing theta in that short dated option. But for selecting strike prices for covered calls, we tend to be more on the optimal track because we're really trying to find a good balance between yield and not having that stock being called away. Because when you own a stock, you typically want to continue owning that stock. That's usually one of the reasons why you sell a covered call. But when you sell a cash secured put, you actually want that put to be exercised because you want to own that stock. So typically when I set my settings for cash secured puts, I select short term, but I select aggressive when it comes to my risk tolerance for cash secured puts. So you can set your own settings independently of each other, but these are the settings that, based on our back testing, seems to provide the best yield for selling cash secured puts. And what you can do is simply create these settings, and all you have to do is save as default. And what we do here on Options Play is, instead of having to pull up a full options chain and go through pages and pages of options chains to find the 30-day or 45-day option and then search for the 30 delta call or a put, we do all of that work for you, and we tell you exactly which expiration and strike price meets your criteria. And more importantly, we provide you with data to show you how much premium you're actually going to receive and what that premium translates to in terms of both raw return and annualized return. So you have a quick sense for how much yield you're actually getting or how much discount you're actually getting off of putting in a limit order. So going in the Apple example here before, I plugged in Apple earlier, and what it spits out for me is a March 1st 165 put. So a little higher than the example that I gave in the PowerPoint presentation. So selling a March 1st 165 put, this expires in 22 days. This will generate $187 in income, which translates to a 1.09% raw return. What that means is that if Apple goes below 165, I will own the stock at 165 minus the $1.87, which is what I received in the income, which is a 1.09% discount off of the 165. So compare that to outright putting a limit order at 165. If it gets filled like a limit order, you're going to get an additional 1.09% discount off of your purchase price. So would you like to get about a 1% discount on all your stock purchases? I certainly think that many of you would like that. And if that's the case, that's why cash secured puts is a strategy that you should consider. And Apple is actually a stock with relatively low volatility, which means the discount that you receive is fairly small. Compare that to maybe a pharmaceutical stock like Amgen, which is trading around roughly the same price at 184. As you can see, so in this particular case, I actually also get relatively similar risk profile. So selling a March 1st 177.5 put, so about a $7.5 strike price below the current price, so about a $7.5 discount. On top of that, I get an $188 in income, which is another 1% discount on top of that 177.5 purchase price. And this comes out to be a 16.93% annualized return on a stock that currently pays only a 3% dividend. So you're actually increasing your yield by a significant portion by selling a cash secured put. And if you don't get filled, meaning if the stock doesn't go below 177.5 before expiration, you simply do this again. You come back to options play, plug in Amgen, and it will instantly spit out an expiration date and strike price for you to sell another cash secured put. And this is all designed to make your life as simple and as easy as possible. So if, let's say, you want to buy Microsoft, which is trading at 105 right now, this is telling you to say, so it'll ask you, do you own shares of Microsoft? You can click on no to get the cash secured put, and it will spit out the March 1st 102 puts. So a put that's about $3 below the current price, which gives you a $3 discount, similar to placing a limit order at 102. But in addition to that, you get $106 in income, and that's per 100 shares. So that's, again, an additional 1% yield on top of that. So meaning if the stock goes below 102 on March 1st, you will purchase the stock at 102 minus the $1.06 that you receive in income, which means that your purchase price is actually 100.94, which is about a 1% discount on top of the 102 price that you're receiving. And this is really how we can make the process of helping you find a cash secured put on all the stocks that you want to purchase instantly and as quickly as possible. So you can set up a watch list with all the stocks that you're following and all the stocks that you want to purchase. All you have to do is click on a single stock, and we will instantly provide you with the starting point that you should be looking at, instead of having to pull up an option chain and go through pages and pages of expiration dates and strike prices, simply returning for you the cash secured put that makes sense and all the relevant information so that you can see how much discount are you actually receiving. How much discount are you actually receiving, how much premium it is, and what the yield is on that stock. So IBM, a very high yielding stock at 4.6%, if you wanted to purchase this stock at a lower price, which is trading at 133, this is telling you to look at a March 1st 130 put, so about a $3 discount off the purchase price. And in addition to that, you're going to receive another $97 per 100 shares, so another 73 basis point discount off of that stock purchase. And as you can see, I can quickly type in a stock, any stock, and instantly within a few seconds get to see where the expiration and strike price without having to pull up an option chain and go through all that work of searching through those searching through those chains and then trying to find out which expiration and strike price makes sense, and then calculating yields. Many times, if you're just looking at an option chain, you have to calculate these yields manually because you're only seeing that this will give you a $310 discount. So then you have to figure out how much is that in terms of yield. This does that work for you. And if you want to place that trade, all you have to do is hit the trade button, and we give you all the details to enter this trade into your broker's platform. This is all designed to make this whole process of finding a cash secured put to executing that down to just a few seconds, as opposed to a few minutes that you typically have to go through when you're using an option chain. And lastly, what I find great about this whole process is that sometimes when you go searching for a cash secured put, you might pull up an option chain, you go through all the expirations, you go through all the strike prices, and then you realize there's just not enough strike prices, or there's not enough premium in this, and you end up doing all this work for absolutely nothing. This platform makes that process a lot simpler. So for example, if you're looking at Ford, and in this particular case, I was actually able to find a cash secured put. I want to see if I can find a stock where we're not able to find a cash secured put. Looks like we're actually able to find quite a few cash secured puts on a lot of different stocks, even low price stocks like Sprint, which is usually typically hard to find cash secured puts because the strike prices are so far apart from a percentage standpoint. So as you can see here on the Sprint here, the $5.50 put only receives $3 in income. That may not even be enough to overcome your commissions on this particular trade. So this really tells you very quickly the ability not only to instantly know where your starting point is, but make a decision as to whether this is a trade that you want to execute within a few seconds and not spend a few minutes and then realize that there's just not enough premium in a particular name. So this is all designed to save you guys as much time as possible. Again, just a reminder, when you sign up for Options Play, create a watch list with all the stocks that you own or that you want to own. And this will allow you to instantly click on the income panel and see cover call opportunities for stocks that you own. By clicking on yes, you can type in the number of shares you own and see which cover calls to sell. And for those of you that are looking to sell cash secured puts, you click on the no side and it will spit out the cash secured put based on your income settings, which you can view here at the bottom. Again, for those of you that are brand new to Options Play, make sure that when you first utilize the income tab, you use the income settings and set those settings, because once you do that, every single strategy that we show you under the income tab will be based on your personalized needs. And lastly, if you want to make minor adjustments, which some of you may do, if let's say for a particular stock you're not as aggressive, or you want to get more aggressive on a particular stock, instead of having to pull up the full option chain to look at the whole universe, we give you what's called an options grid. So we show you different opportunities, so different expiration dates, different strike prices, but showing you in a limited universe. So you have a more limited universe to choose from, instead of having to pick from the whole option chain, which sometimes can be a little overwhelming. And that's really designed to help you navigate these. So if you want to change the expiration date, if you want to change the strike prices, you can do so without having to go through that full option chain. So with that, that just goes over what I wanted to share with you guys here today. I want to thank everyone for taking the time out this afternoon and taking a look at this webinar, which is really designed for all traders, whether you're a stock trader or an options trader. Anyone that has an equities account or a portfolio should be considering this as a strategy, as an alternative to outright buying the stock. And based on the previous poll, already 50% of you are using this strategy, which is great. That means that you understand the strategy and you understand the benefits of the strategy, and that's really what I'm hoping to highlight. But there's still quite a few of you that are not utilizing the strategy, and this is really what I was hoping to highlight as part of this webinar. So with that, I want to thank everyone for taking the time out this afternoon. At this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for here today. So there's a question here. How long does it take to get stock in your account? So we are not a brokerage firm. You own your stock, or I'm sorry, is the question with respect to if you short the stock, if you short the put, when do you actually get the stock? So as soon as the the buyer of that put exercises their put, you effectively instantly will receive that stock in your account. So if let's say you expires on Friday below the strike price, you will see that stock in your account Monday morning. Does it say what the odds of them are expire worthless? Yes. So we have what's called the probability of expiring worthless indicator on all of our income strategies. So this March 48 put on Intel has a 65% chance of expiring worthless. So it's right here on your screen. Alex is asking, if I'm using the strategy for income and using 20 deltas, which one is better, cover calls or cash secured puts? So which strategy you use is dependent on whether you own the stock or if you want to own the stock, because cover calls, you can only sell a cover call if you own the stock, and you should only sell cash secured puts if you want to buy the stock. So the question to you is, do you already own the stock, or is it stock that you want to buy? Because that will dictate whether you should sell a cover call or a cash secured put. Guillermo's saying, how about if the stock goes up in price before you own it? So that's the same as a limit order. If the stock simply moves higher, you don't participate in it at all. But when you sell a cash secured put, you receive the income. If you place a limit order, you get nothing. So if the stock goes up, you don't participate in it. But at least if you sold the cash secured put, you have some income while the stock went higher. Vincent saying, can you do this on an ETF like EEM? Absolutely. So a lot of users own ETFs. You can put an ETF in here as well and see if there's a cash secured put. I will say that a lot of the passive ETFs out there, a lot of the Vanguard ETFs, Fidelity, Schwab ETFs, you may not find much premium in them. A lot of them are relatively lower priced. EEM, I would say, is a bit more volatile because it's an emerging market one. But a lot of the total market ones like VTI, these are very similar to the S&P 500, but they're lower priced. Sometimes they're more difficult to find premium in them. But yes, you can place any ETF into options play and get the same income strategies as you do for an individual stock. Greg is asking, how do you decide between selling put or buying the stock? So in my opinion, if you're willing to put in a limit order to buy the stock, you should consider you selling an outright put to do so. The only difference is if you expect a very short-term dip and you think that it's just going to be a very quick pullback, and you have a very strong desire to be in that stock, then you perhaps will just want to outright buy the stock. But if you are willing to be patient and you're okay with waiting and you you prefer to purchase at a lower price and rather prioritize getting in the stock as quickly as possible, in those particular cases, that's when I think you should be selling a put instead. Guillermo, is your favorite setting optimal and 40 delta? I think you mentioned it. Yes. So I like using short-term aggressive settings for my cash secured puts, because the point of selling a cash secured put is because I want to own that stock. So I generally want to increase the probability of me owning that stock. And the way to do so is by selling an aggressive put. Don, your question about plans to go with live pricing rather than 20 minutes delayed. Yeah, so that's something that we're actually actively in the plans of doing. We actually just had a chat with the new market data provider yesterday on how to provide that for users. So that is something that we are working on, and we hope to provide that as soon as possible. Lauren is asking, would you please show how to use this with rolling out a put on, say, CGC? If you don't mind telling me a little bit about what you mean by that, I'm happy to do that. But if you simply are trying to roll a put, the fact that you're in a put doesn't matter, because that just means you're buying back an old put and selling a new one, and you simply use this income tab. So let's say you've already sold the 45 put on CGC and you want to roll it out. So what you would do is you come to Options Play, plug in CGC, see that you should sell the March 1st 43 put, you buy back the old put, and you sell this new March 1st 43 put. Rolling it just simply means buying back what you currently have and selling this new one. Do you set hard stops on your put? No, I don't, because the whole point of selling a put, I'm okay with both scenarios. Either the stock shoots higher and I keep all the premium, or the stock goes lower and I purchase the stock at the price that I wanted plus the discount. So generally speaking, I don't place any stops or limits on a short put. Raymond, thank you very much. I really appreciate it. I hope that this is really helpful in helping you guys better understand these strategies. Can I be assigned before the expiration date? Absolutely. You can be assigned early before the expiration date. And this is, in my opinion, one of the better outcomes of an early assignment, because now you get to purchase the stock at a discount instantly without having to wait all the way till the expiration date. So you actually get an early assignment, which means that you are able to capture the income from that short put instantly. You don't have to wait till the expiration. Ralph, one possibility you didn't mention, the stock goes down below 160 expiration, you collected $2, put the stock, and you effectively buy at 158, but now the stock is selling at 148 or less. You did not buy it at a discount. You bought the stock for 158 when it's trading at 148. So Ralph, that's a very good point, but you have to compare that to putting a limit order at 160. If you place a limit order at 160, you now purchase it at 160 and then you're down $12. Now you purchase it at 158 and you're only down $10. So again, that's my point, is that it's not to say that you can't lose money. If you think the stock's going to go higher and the stock goes lower, you're going to lose money. The point here is that you're going to lose less money when you sell a put than if you simply purchase it with a limit order. So again, make sure that we're comparing the right thing. We're comparing a limit order to selling a put. In this particular case, when the stock moves lower, you're losing $2 less per share by selling that put than if you just simply placed a limit order to buy at 160. That I want to make sure is clear. I'm not saying that short selling a put, you're not going to be able to lose money. You can lose money when you sell a put, especially if you are wrong in the fact that, if we're bullish on Apple and Apple goes back down to 148, then we're going to lose money. There's no doubt about that. The question is, how much money do you lose? If you place a limit order, you're going to lose $12 a share. If you sold a put, you're only going to lose $10 a share. That's what I'm hopefully was able to convey. Are the put options often exercised? Well, that really depends on the stock is below the strike price at expiration. If the stock price is below the strike price at expiration, you're almost guaranteed they're going to be exercised. If it's above the strike price, you're almost guaranteed that's not going to be exercised. It's just like a limit order, right? Like if the stock goes below your limit order, you're going to get filled. If it doesn't go below your limit order, it's not going to get filled. You can think of it similarly when it comes to selling a cash secured put. The assignment will happen to the end of the trading day. So on expiration, it will happen after the trading day. If it happens early, it can happen at any time. But yes, it usually happens at the end of the trading day. How does option IV play into selecting a put? So the implied volatility is actually what we calculate delta off of. So there's a very high implied volatility. That 40 delta will be further away from the current price. If the implied volatility is very low, then that 40 delta will be much closer to the current price. So delta is just really an expression of implied volatility, if you will. Ideally, is it best to buy a cash secured put when a stock is deeply oversold or overbought? That way you are less likely to get assigned the stock if you want to avoid assignment. Thoughts, as in your example with Apple, when you got severely oversold versus buying a put now when it could pull back further. So Brendan, you can certainly try to time your cash secured puts based on overbought, oversold. But again, the goal of selling a put is to own the stock. If you want to avoid assignment, I don't know that selling a cash secured put is the right strategy for you. Selling a cash secured put is because you want to own that stock. So I wouldn't necessarily make that comparison if I were you. You can certainly try to time it to get a little bit more income. But again, you wouldn't do it to avoid assignment, in my opinion. How are commissions when you get the stock put to you? That varies from broker. Some brokers will charge you a fee to do that and charge you commission on the stock. Some brokers won't. So that's a question for your broker. Greg is saying it's only a loss if you sell the stock. I'm not sure what you're referring to. If you're referring to the other example that I was talking about, if the stock goes lower, your losses, you're right. It's an unrealized loss. But still, what I'm trying to say is that your unrealized loss when you sell a cash secured put is smaller than your unrealized loss if you bought the stock with a limit order. Don is saying, rather than sell a put naked, do you buy a lower strike put to protect against the downside? So that's a slightly different strategy. That is a credit spread. And you can certainly do that if, let's say, you don't have enough capital to put up for a cash secured put. That is one way that you can effectively sell a cash secured put without putting up as much margin. So that's a really good point, Don. For those of you that want to purchase that stock, but maybe you do want to have some type of protection to the downside, you can buy a further out of the money put, especially if you buy a really low delta put, like a 10 or 5 delta put that costs you just a few pennies and just puts in that kind of cap to the downside, so that no matter what happens, you can't lose more than a certain amount. And that's a really good point, Don. If you're concerned about a stock that you're purchasing, that if it just falls through, and if you're concerned that you buy Apple and the stock plummets down to $95, you can certainly sell a credit spread instead. A very good suggestion, Don. Thank you so much. Bob is asking, if you want to buy a stock, does it make sense to use technical score to get aggressive, conservative, optimal to get best price? So the technical score is a relative strength ranking. It usually doesn't have, it's not very good for short-term directional bias, if you will. I think that if you want to set those types of parameters around based on a directional bias, I would use the 1 month and 6 month trend indicator perhaps, or even maybe a short-term momentum indicator like RSI, MACD, or stochastics, any of those type of momentum indicators. You might use that perhaps. So if something's overbought, you might be more conservative. If something's oversold, you might be a bit more aggressive. So I would use those types of indicators, short-term momentum indicators. Technical score is really sometimes taking into much longer-term indicators to calculate that. Alexander's saying, I use your platform to validate my research, and sometimes the bid-ask numbers are not what my broker shows. Any thoughts? I haven't really seen any deviations from my platform versus what I've seen on my trading platform. If you have a specific example of that, I'm happy to take a look at it. And keep in mind that the prices here are 20 minutes delayed. So if you're looking at real-time quotes and you're trying to compare it to 20 minutes delayed, that does make sense that they don't match up. But, you know, options prices don't usually change that much as the stock price, where it changes by the second. So that's why I generally have not found a huge difference between the bid-ask prices on our platform versus my own real-time trading platform. Greg is saying, also, once you own a stock, you should be selling cover calls against it. Absolutely. If you sell cover calls, I recommend that you start as soon as you own the stock. If you wait, you can wait. However, you typically find that, especially if you're down on the stock, a lot of times people don't want to sell cover calls on a stock that they're down on. And a lot of times you don't have control over that. So you want to sell cover calls as soon as you own the stock so that you have the opportunity to start providing that downside buffer as soon as you own that stock. That seems to be the questions so far. Any last questions? If there are no more questions, I just want to thank everyone for taking the time out this afternoon. Like I said at the beginning of this webinar, this is recorded, and I will send out everyone the recording with the slides in about 30 minutes. So look out for that, especially for those of you that want to watch the recording or follow along with the slides. I'll send that out in about half an hour. So thank you so much. I hope you guys found this useful, and I will see you guys next week.